Welcome to this session in Greenspoon Martyr's Innovation Week 2020, Facing Challenges and Seizing Opportunities in the Post-Pandemic Recovery for Investors and Entrepreneurs. It's quite a mouthful, but I think it's going to provide us with a very interesting session. My name is Eric Simonson. I'm a partner here in the corporate group at Greenspoon Martyr, and I'll be your host for this session. A couple of preliminaries before we get to the meat of the session. Now we've got the video. My apologies. Again, I'm Eric Simonson, and welcome to the session. A couple of preliminaries. The session will run about 45 minutes, and if you have questions or that you'd like answered, you can use the button to ask those questions, and we'll either try to fit them in at the end of the presentation, or if it works very well with the discussion we're having, address them as they come up, depending on the nature of the question. So without further ado, we'll get into our session. Today, as I said, I'm Eric Simonson, and we have with us Richard McCary, who is the Chief Strategy Officer of Delos Living, which is a very interesting company he'll talk about, and a very appropriate one given the past year we've been through. But he's also the founder and CEO of Macri Advisors, which is a business advisory firm that helps early stage and mid-stage companies, most recently primarily in the technology and biosciences spaces, but in the past somewhat broader than that, in achieving their goals through improvements in business strategy, attracting proper board members, partners, and other methods for increasing value. I first dealt with Richard 15 years ago in basically a shareholder revolt against a small public biotechnology medical company that successfully improved the board, improved management, and resulted in a real explosion of value, and have since dealt with him on many other matters since that time. Also with us is Greg Bassek. He is the founder and chief executive officer of AXS Investments, which is an investment management firm based in suburban New York, just outside of New York City in Westchester. I've been working with him since he started his business, created a great new company through the use of, in part, opportunity zone financing, but also a really interesting LLC operating agreement that is designed for continuity of the business. One of the issues that we often face as lawyers and as business people in businesses that are very heavily dependent on personnel is, how do you assure continuity when people go, they retire, things happen? How do you assure continuity of business? So we worked very hard on getting a business structure set up that should last indefinitely and successfully. What a year it has been. Rich, if you can get your video on, I don't think you're up yet. There you go. There's Richard. I have been practicing corporate law for almost 35 years, and I have been through the flash crash in the late 80s, the downturn in the economy in the early 90s, the tech boom in the late 90s and early 2000s, the tech crash after that, then shortly thereafter, 9/11 in New York, which shut down all business for several months. I mean, it was just a horrific situation. Then the whole mortgage blow up in the late aughts. Then I thought I had seen it all. I clearly hadn't when this pandemic came around. And I can't help but think that our methods of doing business and the direction that business people and lawyers have taken over the past, I don't know, generation or two, are in for some really serious changes. And that's what we're going to discuss today. We're going to talk a lot about the opportunities as well as the challenges of dealing in this almost post-COVID recovery that we're in right now. So first, I'd like to introduce, again, allow my panelists to tell a little more about themselves. So first, I'm going to go to you, Rich. Tell us a little about who you are and what you do.
All right. Well, first of all, Eric, I can't believe I've known you for 15 years. And the company that you mentioned Advocation was a $50 million market cap company, and today it's somewhere between 7 and 8 billion. So that did work out. My background is in the 90s. I was a Wall Street guy, working with institutional high net worth investors. I transitioned in the 2000s to be an independent analyst, and I worked with hedge funds actively for most of that decade. And as a research guy, I started to see a lot of opportunities in startup companies, particularly in med tech, biotech, and tech in general. That transitioned me into venture capital. Did a lot of investing, bringing together investors into the startup arena. And then in many cases, I started to work with the management teams as an advisor, board member, consultant. That led me to become more actively involved. In the case of the company we mentioned, I became co-head of business development for Sarepta Therapeutics in Cambridge, Mass for a few years. But most notably, I, about 9 years ago, got involved in sort of the formation of a company that I thought was really intriguing, was about health and well-being in the built environment, how the buildings we live and work in affect our health. It was very early, there's only a few people. It was started by 2, at the time, partners from Goldman Sachs. I got involved, I helped to start build the strategy for the company. It became bigger, it got well funded to the tune of hundreds of millions of dollars. Today, Delos is the leader, pioneer and leader in the health and wellness in the built environment. That means air quality, lighting, ergonomics, pretty much everything that could affect your health and well-being. Sort of a parallel movement to what happened with LEED and the environmental movement around creating more energy efficient buildings. In fact, we created an organization called the International Well Building Institute. That created the Well Building Standard. It's covering over 1 billion square feet around the world right now. And in reaction to the pandemic, we'll get into it, we created the Well Health Safety Rating. I should say the IWBI created that. And if you ever watch CNBC or CNN, you see J-Lo, Robert De Niro talking about healthy buildings, that's us. So I'll leave it at that. My other life, Macquarie Advisors, I continue to advise companies in the biotech, medtech space. Been an interesting year in that regard. My focus there is in neurodegenerative disease. I have both a professional and personal interest in Alzheimer's specifically.
Okay, Greg, tell us a little bit about you and AXS.
Okay, great. So this is Greg Bassick. I've been in financial services for many years with a focus on building businesses, both as an entrepreneur and as an investor. Back in 1999, I co-founded Smart Portfolio to bring institutional solutions and equity research to individual investors that we scaled and later sold to TheStreet.com. In 2006, I founded a company called Index IQ, asset management firm that was focused on bringing alternative investments to individual investors and other solutions that were really widely espoused by pensions, endowments, and foundations to level the playing field for individuals. And we ultimately sold that business to New York Life. And then a few years ago, as the financial markets continued to evolve, we saw similar opportunities, and I co-founded our current company, Access Investments, to bring better access to individual investors to alternative investments and other institutional solutions. We're seeing that kind of an opportunity is very timely as the markets are moving to this new normal environment. And so this panel is therefore very timely as we think about some of the challenges and opportunities, as Eric mentioned, for this post-pandemic period ahead.
Well, thank you. And let's dig right into our discussion today. Maybe I can ask each of you, let's go with you, Greg, first this time. What were your biggest challenges over the past year? And as things evolved during the pandemic, both operationally and sort of business strategy, tell us a little bit about how your firm, which is a pretty young company, only a few years old at this point, navigated those waters.
Yeah, that's a great question in the context of the overall environment. Interestingly, being in a regulated industry, in our case, we're regulated as a registered investment advisor by the SEC. One of the requirements that we need to have in place, even in a non-pandemic and a normal environment, is business continuity, processes and procedures for disaster recovery. So from a positive standpoint, our move to a remote environment and our whole business model is a very seamless transition, very much we saw a lot of continuity from an infrastructure standpoint, a system standpoint. Some of the challenges were not so much in line with the core of our business and growth around revenues and sales and so forth, but really the migration to remote as it impacted folks from a social interaction standpoint. We had, as I mentioned, already been set up to be remote, but not having the day-to-day interaction definitely was a challenge among folks on the team, as well as we reach out to our partners and our prospects. It was definitely a new normal in how that was done. So from a business model standpoint, our focus is on educating and selling our solutions primarily to financial advisors and other intermediaries. And as those firms were similarly closed from an office standpoint, we had to migrate to Zoom, as was the case in many industries. Our hard copies moved to digital copies and so forth. But interestingly, that challenge became an opportunity because we started benefiting from the fact that financial advisors and other folks in our target market were at home more, they were in front of their computers more, they had less travel time, so that led to greater opportunities for connecting. So, to boil it down, I'd say the daily social interaction among folks on the team was a bit of a challenge, and they're eager to get back in as we think about reopening this fall. And then number two, the challenge of reaching out and connecting to our target market as they were away from their offices, interestingly and somewhat ironically, became an opportunity as their own work from home status created greater ability to connect digitally.
Rich, how about you? You sort of wear two hats between the advisory business, which deals with a lot of different companies, and of course you work for Delos. Tell us how 2000 affected you and your business in the way you operated or the opportunities you saw.
Sure. So, the biotech side of my life, where going back almost 15 years, I've been involved pretty actively in the infectious disease space. So I had been following what was happening in China really close. And by the beginning of February, I was already convinced, as were a lot of people in my network, this was a pandemic. That did not help ultimately what happened, because for us, I think around mid-March, in a weekend at Delos, we transitioned from being in the office to working from home, in some ways thinking that might be weeks or maybe a month or two, not thinking it would be, a year. So that was dramatic that, we suddenly were working virtually without a roadmap. But what made it more dramatic was we had been out there for 8 years talking about antimicrobial surfaces and air quality and air filtration, ventilation. These were like part and parcel to creating healthier spaces. And suddenly the world cared about that significantly. And so our challenge was the phone was ringing off the hook. People wanted to know what they should do. And this is, major corporations, top real estate companies, brokerage firms, real estate managers, you know, government officials. So it was a crazy time. We had very specialized knowledge, and suddenly we were all remote trying to respond to a demand that wasn't sure what to do. And I'd say that that was the greatest challenge, because in the beginning we were all starting to focus on what can we do in the physical environment to space people. You know, you couldn't get plexiglass. Everybody was trying to separate spaces. You know, what can we put on surfaces to disinfect? What could be long lasting? You know, I'd say the biggest challenge was the science kept moving and we kept learning, and then it started to become politicized. So, you know, the general public and the decision makers themselves couldn't figure out exactly what to do. We, in that period, you know, I think smartly got behind some people that we knew were the experts in the field, people like Lindsay Marr, Joe Allen at Harvard, Richard Corsi, others who were saying, this is airborne. This virus is spreading through the air. And so we redoubled our efforts and we really focused in on air quality, filtration, ventilation. We started making those recommendations. And again, there was sort of a, you know, we do a lot of work in hotels, Wyndham, Four Seasons, MGM. A lot of them were closed. So there wasn't much for us to do there. And nobody was in the office buildings. So, you know, we were also looking where could we find the places that people needed this versus preparing for people to come back in the office. We pivoted and ended up, you know, getting a gangbusters business in helping school systems, universities, senior living facilities to upgrade their air purification systems. And this was, you know, this is in the May, June, July timeframe. It was just a month or two ago that the WHO admitted that this was airborne, and then the CDC followed suit. So we were really ahead of the curve, but it was a crazy time, and it still remains a tough time and a challenging time for people to understand what they should do, because we are now starting to go back into spaces. We're all getting vaccinated, but the risk is still out there, whether that's from a mutant for those people that didn't get vaccinated yet. So it was a crazy time. It remains a robust, high demand period for what we do. And we just keep evolving with the science, trying to make the spaces that people live, work, and play safer.
In your other business, that is your advisory business, what sorts of changes and adjustments did you see and have to make?
Yeah, that was scary, because, you know, you put all this time and energy and money into clinical trials, and you have experiments happening in labs. And overnight, people were told, get out of the lab. You can't be in the lab. Clinical trials, people won't go to the trial site. They won't go to the hospital. It really was a mess, especially that first 6 months for the whole biotech industry. Clinical trials were interrupted, lab experiments, work got set back. But weirdly, and I think this happened in the market in general, with the realization that our way out of this was creating, you know, monoclonal antibody, you know, antivirals, developing vaccines. And, you know, I was in the field, as you know, of mRNA 15 years ago. So to watch an mRNA company, or two of them, develop the first vaccines in record time, you know, was kind of a sense of pride. And I think the whole industry felt that. So we went from this, you know, money's drying up, problems in clinical trials, problems with labs, to suddenly sort of a renaissance, an appreciation of the value of the biotech and pharma industry. And, you know, tons of deals started happening. Money was flowing. Massive amounts of money have been raised in venture funds to fund these companies. So it was sort of any way to explain it, it was kind of a golden period from sort of the end of the summer, almost to earlier this year, where biotech, you know, finally went into a slump. But the industry came back, roaring back, because it learned how to do this all virtually. It learned how to move things forward, and the investor demand and appreciation for what the industry has done, you know, was a big part of that, let's call it that golden period, that I think in some ways is going to continue. Okay, well, that leads us sort of to our next topic, which is what's going to continue. What areas, Greg, do you think are ideally
situated to take advantage of the recovery and the changes in the economy? What do you see as an investment manager?
Well, it's interesting. We're seeing a move to what we're calling the rebalance trade, or the reopening trade, which is a movement to industries and sectors and a focus on investment in individual companies that are poised to do well in a post-pandemic period. So March, April, May of last year, as the pandemic was unfolding, we saw a move into what we call sort of the stay-at-home sectors. Technology was hot, and companies like Netflix and Zoom were really starting to take off. What we're seeing now is a move from some of those technology companies into sectors that we believe are very well positioned, that investors believe are well positioned as the economy continues to open up. Sustainable investing is a big area, or companies in the ESG and sustainable investing space, a big area going forward. Not only because of those companies such as clean energy and wind energy being positioned well for a reopening, but also as the Biden administration policies are very focused on supporting companies in that space, number one. And number two, given the Biden administration focus on infrastructure and some congressional movement as well in trying to work towards some agreement on infrastructure, that's another space that we see poised to do well going forward. One other quick thought I'd share is that even for some of the companies that did really well from a growth standpoint amid the pandemic, I mentioned before, Zoom and Netflix and some of those companies, to the extent they can reposition their business models, knowing that there'll be a new normal going forward, we think that that would be an opportunity as well for companies in those industries.
What do you see as the new normal?
Yeah, great question. So in the new normal, we're very focused on the movement back to travel, movement back to companies that are focused on the hospitality space. But we also continue to see greater levels of consumer cautiousness. So while there's this eagerness to get back to work and get back out there, so to speak, in terms of travel and vacations and movement, we're also seeing a fair amount of data that's suggesting that that'll happen with a greater level of cautiousness among consumers, which again, we think is both going to be a challenge and an opportunity depending on the way you see it.
Well, that leads me to you, Rich, because Delos is in the business of, at least a large part of his business relates to the hospitality space and addressing those concerns. Tell us a little bit about where you see hot areas, maybe it's Delos, maybe it's a number of others, and how that relates to sort of what you'd call the new normal.
Yeah, I think prioritization of, let's call it, health, well-being, and safety is at top of the list when you're talking about hotels, you're talking about venues, and even corporate office spaces. So we're seeing that demand. Our pivot is to get ready for that reopening. We're doing that partially through, on the IWBI side, through the Well Health Safety Rating, helping businesses understand what they need to do, and then basically giving them a verification through the Well Health Safety Seal that work has been done in that particular space, and that's being embraced by some of the largest corporations and real estate owners in the country. The other areas we focused on is, everybody got locked in their home for a large part of a year. And, while that might have driven, the Home Depot and Lowe's and sort of that, home consumer spending, For us, it drove it drove also more concern about, you know, your own home environment. Is it good for you? Is it comfortable for you? Thermal comfort, lighting. So, you know, we have a platform called Darwin that we had put out into the marketplace. We did have to pivot because it really became more about air quality primarily than everything else. So that's an area that we ended up focusing on. I think that's going to be a really important area going forward. But I'd like to couch everything that we're doing around health and well-being and safety into that ESG umbrella, because it really is an important focus when, I don't know, care what sector I'm looking at, people are thinking about that top of mind. And the E in sustainability, a lot of that has to do with buildings. The S, which is about that social aspect, your supply chain, et cetera, your community. You know, that S is also kind of being pushed into our area, employee safety and well-being. So, you know, it's starting to overlap. And I think, you know, companies are looking at that dual, you know, now with the Biden administration and the focus on the environment, they're thinking about both that E and that S. And I think when you're in either of those buckets, health and well-being, or the E and S and ESG, I just think there's broad demand for that, you know, throughout multiple industries, and that people have to contend with both of those. You have to create healthier spaces, but you also have to be thinking about the sustainability aspect of it. I think it's going to be a big driver, and it's kind of where we're going as well, is making sure we fit into that mantra, because it's going to drive a lot of spending in the next 24 months, in the next 5 to 10 years.
Yeah, well, we talked about sort of what's hot. Maybe we can get each of your opinions on maybe what's not. Greg, what do you see? We're entering into a period, and we can talk a little bit about this just as a standalone, of potentially higher inflation. We're entering an era of clearly somewhat more, if not a lot more, government regulation. We are faced with potential tax law changes that could be very significant. And we're looking at an economy that is at least moving closer to normal from where it was before, although we're facing higher energy costs. There's just a lot in that soup mix right now coming together, supply chain issues, which I'd like to talk with each of you about in a few minutes as well. Tell us what you'd be avoiding right now as an investor.
Yeah, so really there's two areas in particular that we would bucket as what's not hot. And we think it's both in the immediate term and frankly, even to a greater extent over the long term as we enter this quote unquote new normal. And it touches on a great point that Rich just mentioned in terms of the importance of ESG and the fact that it's relevant for all industries and all sectors. Companies across the landscape, all industries and sectors that are not moving toward best practices on the environmental front, the social front, the governance front. We're seeing it in each of those categories around diversity and inclusion. So the first big area of what we believe is not hot, both from an investment standpoint and frankly, the sustainable nature of business models, everyone's going to need to espouse becoming more ESG friendly without regard to their space. The second area of companies that we think are going to struggle going forward also overlaps to some extent with another great point that Rich mentioned around wellness generally. And whether it's from a health standpoint or even from a financial standpoint, companies that are supporting wellness broadly defined are going to do well going forward. But importantly, the ones that aren't, we believe are going to be left behind. We're seeing it in our own business and our industry, financial services. Over time, the companies that have focused on educating around financial literacy, financial wellness, financial inclusion, have really better positioned themselves vis-a-vis the competition. At the outset of this session, when Eric shared his thoughts around some of the big changes that took place, let's say over the last 20, 30 years, the internet bubble bursting, the financial crisis happening 10 years later, and now the pandemic. These are times when, again, in our industry, we're seeing a much greater focus around topics like financial wellness. How do investors, how do consumers understand what they should be doing in terms of how those things affect their day-to-day, beyond just investing, it's budgeting, it's savings. So both companies that are less focused on espousing ESG and less focused on all the elements of consumer wellness, we believe are going to get left behind.
So, Rich, what do you see as the dogs, so to speak, sectors that are going to face particular challenges going forward in the current both economic but also tax and regulatory environment?
Yeah, well, look, I'll agree with Greg. Companies that aren't focused on ESG, they're not focused broadly on the health and well-being of their employees, of their customers, are probably going to be on the wrong side of a major wave that's happening right now. It's hard for me just mentally. I'm an optimistic person. I'm always looking at what's hot more than looking at what's cold. What I would say is a lot of things are going to change really quickly. And, whether that's our home buying, online shopping habits, to how we use the medium that we're using right now, all the way, to telehealth and other things that really, we're on a trajectory. Even Delos, we were on a trajectory, making headway, getting people to believe and understand what we're doing and its importance. That all got put on steroids because of the pandemic. Suddenly, what would have been a 5-7 year adoption path for remote patient monitoring and telehealth, 6 months, bam, it happened. What we have been doing to educate people on how important the environment is, air quality, surfaces, lighting, 6 months. Everybody in the world understands that now. So, I feel like there's areas that are going to transition, but I think things have changed so much. I don't suddenly think people aren't going to decide that they want to engage in meditation apps or doing things in their home for their health that they did as part of this. Hopefully they go back out to the gym. Hopefully they're re-engaging in life, but I think there might be some fundamental changes. So for me, it's about uncertainty. And one place I'd have to put that is in real estate. I mean, commercial real estate, certainly the housing market's hot, but there's so many unknowns there. I'm optimistic for the market. I do think people are going to come back. I think we're going to have a big change in that industry. So to me, it's not cold. It's more about uncertainty.
Well, let's transition from that into a little discussion about capital markets just a little bit, and where we stand, the effects on the pandemic in terms of the availability of both public and private finance, and some of the mechanisms that people have been doing to finance businesses or to make their equity liquid. We can talk a little bit about, venture capital, private equity, as well as the public market. So Greg, what are you seeing? Have there been changes, or was this just sort of a hiccup and we're going back to pretty much the same trajectory we had been on?
Yeah, so we're seeing a big change in capital markets. Taking the venture capital space first, year to date, there's been about 75 billion raised in venture capital funds. And it's important to note that that's up significantly from last year in terms of the run rate. Last year was about 123 billion raised. But importantly, we're on pace this year to blast past the 2018 record of 133 billion. A lot of money right now being put into these funds. And part of the reason, we believe, is that venture really thrives in periods of dislocation. It goes back to that theme we were talking about earlier of these challenges also creating opportunities. In our own business, we're seeing it manifest in a couple different ways. Not only is a lot of money being raised in venture capital funds, but we're also seeing a movement toward greater interest among individuals to get exposure to these venture opportunities. Historically, from a structural standpoint, it was hard for individuals to access the venture capital and private equity asset classes. They either had to be accredited investors or couldn't be in a position to put up a minimum investment amount of 10 million or more, for example. So largely from a structural standpoint, individuals were shut out effectively. So we're seeing a big change, not only in terms of dollars being put to work into PE and VC funds, and then from those funds into VC and PE backed companies, but a big migration as well of individual investors looking for solutions that have only recently emerged in the form of the venture capital and private equity asset class exposure in more retail friendly wrappers like mutual funds, interval funds, and other structures that provide them with that access. A big set of developments for financial services.
And Rich, what have you seen? You primarily live in the sort of venture capital and growth equity space in terms of your business interests and things you're involved with. Have you seen, aside from the hiccup that you mentioned before, the maybe 6 months of people not knowing what to do when the pandemic broke out, are you seeing any changes in focus or different processes by which these institutional investors evaluate investments?
Yeah, I mean, I'll just go back to the primary, I was blown away by, the massive economic hit we were taking at the beginning of this and how quickly the markets decided to look past it and start to, move up in the face of all the negative things that were happening. In some ways, it felt like it didn't make sense. And again, as Greg mentioned, the amount of money that came in to venture funds, I think it's a function of the massive amount of liquidity that's been injected into the system. I don't think anybody disagrees on that. Couple that together with, an interest rate picture where, they're so low that the appetite for gain, the appetite for that upside really drove so much money into risk, whether that was broadly in the market or into the venture sector or beyond the venture sector into crypto and other areas that have just been inflated. So I think the appetite for risk, at least at this moment, went up dramatically. I think that the size of deals has changed. I mean, biotech used to be a $10, $15 million deal. Now Series A at 50 to 75 million, boilerplate, 150, 200 million, not unheard of. I mean, the game's changed. The amount of money that is under management and the size of these funds, it's changing how they invest. It's changing a lot about how, particularly in biotech and medtech, the stages of capital happen. And that has good and bad ramifications because it also, puts a lot of pressure on these teams to deliver when you're handed that amount of capital, when you're, a university spin out with an amazing technology, a new CEO, and you've got 75 million, go run. So I think it's a really interesting period. And that's also in the tech space, just a lot of money, a lot of liquidity. And, I don't know when the party ends, but at some point, I don't think this can drive the way it's driving, but I don't see these trajectories, on tech and biotech and all these areas. It's hard to see how they tail off. Maybe just a speculation part of it drops off and gives us a little hit.
I'm going to take a slight break here. We've gotten a couple of questions from some of our viewers. I'm going to hit the last one first. It was a question you, Richard, and this goes back to Delos, and it reads, it sounds like Delos has a few solutions for schools around lowering the risk of COVID. Are these economically viable for schools and state and local governments to afford, and how quickly can those solutions be enacted? Just briefly.
Yeah, no, that's a great question. It was one of the pivots we made. I think most New York City schools have multiple air purifiers that we help them select, and part of the portfolio of technologies that we brought forward. I think at this point, somewhere between 250 and 300,000 mobile air purification units have been put in school systems, major school systems across the country because of us and the work that we've been doing in that area. It's really important. It is affordable. We're doing it based on science, both in the evaluation of the product, but also how many of them you need inside of a space to be operated to lower that risk. So I think it's really important. And the latest stimulus package provided a lot of money to school systems to do just that. And there's been a number of media stories because they're confused about what they should pick. And in some cases, there's a lot of people running around offering a lot of solutions. We bring the science, we bring the evaluation, and then help educate the school system and ultimately the parents and teachers and others how this is going to benefit, lower that risk. Really important question. And we've been on top of that now for about 7 months.
Okay, and now some for you, Greg. There were two other questions. One, were there any silver linings you found amidst the pandemic for either entrepreneurs or investors? And then a related, which was the capital markets. And I think we addressed this next question also, asking how would you rate the general investor appetite post-pandemic? It's clearly pretty strong, as we know, but what they're asked specifically, which investor group is most active, VC, PC, or what kind of institution? So maybe you can give us your thoughts on those two questions as we wind down the session.
Yeah, absolutely. There definitely were some silver linings. This theme keeps coming up in this session around the challenge and the opportunity. One of the silver linings is that there's been, before the pandemic, a greater understanding among investors that the historical institutional way of investing, not just stocks and bonds, but also alternative strategies, are a really important part of a fully diversified portfolio. But on the individual investor side, while that was slow moving over the last number of years, the uncertainty in the markets, the volatility in the markets, all driven by the uncertainties and volatility of unknowns around the pandemic, the reopening, much greater focus of the entire investment landscape on alternative investments. We launched and started scaling the company long before the pandemic, but that's definitely a silver lining and an unanticipated positive consequence, greater focus on alternative investments. And I would say the same thing about the rating the investor appetite for investing. It remains strong, but we also are seeing a shift from more concentrated portfolios that historically would be primarily stock and bond exposures to an increasing appetite for those strategies that are designed more for periods of uncertainty and volatility, alternative investments.
Yeah, and I've certainly seen the change in the legal profession. I think that while lawyers will go back to the office, they won't be in the office all the time anymore. I think we found that we can function pretty well remotely. The other thing that I think it has proven is that, particularly for large firms like Greenspoon, with a lot of offices in a lot of places, we can function just as well remotely as we can in person in terms of providing services. And that provides levels of efficiency that I think the legal profession was moving to maybe slower than it should have. But I think it's clearly picked up on that. And I think that's going to be reflected in a greater value proposition, as well as greater just efficiencies and control of the lives of the lawyers, which will attract good people who might otherwise have, not had the opportunities. If you're located in Denver and you're doing work on New York matters, well, that gives you just as an exciting time of it, and you get to have the Rocky Mountains outside your house as opposed to, Queens or something like that. So I think we're definitely seeing some changes there. We are now finally entering the end of our program. I want to thank the audience for maybe, we have to thank you. Thank the audience for listening, and to my friends Greg Bassick and Richard McCary for doing such a terrific and interesting job on today's program. Thank you so much, and this will be up for those who don't get a chance to see it. Tell people who missed out. This will be up on our website. You can view these sort of podcast type things when it's on the website at any time and at no cost. So I just want to thank everyone for participating today. Thank you.